It all depends on how scared people are, and that's it. Likelihood gold is higher, about 90% likelihood that it's going to be higher than it is now. I think that that's probably accurate, but one of the things that this is leaving out is, what is the likelihood that the stock market is going to be lower? And that's probably like an 80% likelihood. So now you've got a likelihood of 90% for the gold upside, 80% from of the stock market's downside, and looking at that value change. It isn't as important of just one of them going one direction or another, but when both of them are going opposite directions, these magnify your potential losses and gains depending on where you are, what you're invested in at the time. Let's say you have $1 worth of gold and $1 worth of stocks, and then the stocks fall by 50%. Well, your $1 worth of gold that didn't go anywhere, it's still $1 worth of gold, can now buy twice as many stocks. So that 50% decline in the stocks added up to a 100% gain in the value of gold compared to stocks. Now, let's say the stocks fall by 50%, and a 50% retracement is very common. In a big stock market correction or pullback, a crash can be a whole lot worse. 70% correction in value during the invisible crash from 1966 to 82, and I think it was I can't exactly remember, but it was right around 90% that of value the stock market lost from 29 to 1932. So a 50% correction or pullback is quite normal. The NASDAQ lost like 70 something, 38% retracement, 50% retracement, 62% retracement. These are the most common corrections that you see in the stock market. But let's take that 50%. The stock market falls by 50%. Well, if gold goes up by 50%, 50 plus 50 doesn't equal 100. If gold goes up by 50%, now you've got gold worth $1.50 and the stock's worth 50 cents. So you can now buy 3 times as many stocks. In this case, 50 plus 50 equaled a 200% increase in the value of gold compared to stocks. Not the price, forget the price. The price means nothing. What can you do with the proceeds? The price is just a number you put on it as you temporarily use currency as a medium of exchange. The interest rates have gone up dramatically over the past year, and so this spike is only since the interest rates have been raised, which was last March or something when they started raising them. So it's less than a year ago that this, and it still has, so less than 1 year out of the 5 years of rollover has been completed. So it's got this is maybe 1/10 of the amount of the national debt has already caused this spike. What happens when the other 9/10 hits? The reason that this is important is last year, gold sort of broke even. It started and finished the year right within a few bucks. And so the stock market fell 18% over that time. So let's just try to eliminate the dollar from the equation here and see what that actually means, because gold, people say, oh, well, gold didn't do anything last year. Yeah, but real estate is down, stocks are down, bonds are down. When the yield goes up, the price goes down. So if you were holding on to existing bonds, they're not worth as much in the aftermarket because they don't pay as much interest. And so all the other major asset classes fell. Cryptocurrencies, they're all down. So everything is down. Gold broke even, silver rose, but I'm going to just focus on gold because that's what the central banks hold. It's more, even though silver has been used as money many more times throughout history than gold. Gold is still considered the standard of money when it comes to central banks and such when it comes to nations throughout history. And what does that lead to when people panic, when there is a crisis? They run towards safe haven assets. Well, because of the FTX scandal, there's still a dark cloud over the crypto space. Bonds, like I said, they will get this last safe haven pop because interest rates, when they plunge, the value of bonds on the aftermarket increases. So, where is the other safe haven? It's gold and silver, and that is about it. And, you know, people that are in my insiders, the insiders, people that have bought they've purchased a certain amount of gold or silver from goldsilver.com, get my insiders updates and action alerts. And whenever I make a purchase, I show them why. It's going to be an absolute disaster. Time between rate hikes and cuts, and they're going to keep on slamming the interest rate up until they cause a crisis, and then they'll bring it down to zero. The gold during the biggest stock market crashes, and so here you've got all of the biggest stock market crashes going back to 73, 74, and gold's performance during all of those, and there's only one where gold actually fell more than the stock market, and that's because gold had just hit its peak in 1980, so it was coming down off of its peak. And what does that lead to when people panic, when there is a crisis? They run towards safe haven assets. Central banks have been buying gold at an unprecedented pace. Is the freeze of Russia's central bank assets to blame? Potentially big implications for global financial markets. And this is what this is. This is the net buys or sells going back to 2008. And what is interesting is the net buyers are mostly in the East and the net sellers are in the West. So it is a transfer from East to West. And I just want to show you gold's performance since 2002, and it's been pretty darn spectacular. We're down here at about 250 something, and we're about, I believe that this year, if we see new highs, that's when gold gets in the news. That's when everybody starts buying again. That's when your neighbor starts talking to you about investing in gold.